and that act alone will increase the sustainable withdrawal rate on your stock market portfolio from 4 to as high as 8% with a 95% success rate.
Highlight the differences between a 401k and what that does, and then if they had the life insurance retirement plan going side by side.
So what I would do is if I believe that tax rates in the future were likely to be dramatically higher than they are today, if my personal income tax bracket I predicted was going to be higher, I would not do a traditional 401k. I would do a Roth 401k.
Right.
Roth 401ks do have limits on how much you can put in. If you're younger than 50, you can only put in 23.5. If you're older than 50, you can put in, 31,000, unless you're in that 61 to 64 age bracket. You can put in a little bit more to catch up. Mm-hmm. So there are going to be contribution limits. You don't really have the income limitations with, the Roth 401k, but if with the traditional Roth IRA and IRA, you have income limitations. The other thing is with the cash value life insurance, it does have a death benefit that doubles as long-term care. You're not going to get that with the Roth 401k. And I got to be very careful with people because the one does not replace the other. They work best when used in concert with each other. I love, for example, using cash value life insurance as what I call a volatility buffer concept. And this is something that a recent Ernst & Young study came out with, where they basically, they compared two different scenarios. They compared somebody who was doing just straight investing, and then they compared someone who did investing and then put 30% of their retirement savings into cash value life insurance. And basically what they found is that if you can save between 3 and 5 years worth of living expenses in your cash value life insurance by day one of retirement, and then in the year following a down year in your stock market portfolio, call it your Roth 401k, what have you, if you can pay for your living expenses out of your cash value life insurance, what that does is it gives your stock market portfolio, your Roth 401k, a chance to recover before you take further distributions. And that act alone will increase the sustainable withdrawal rate on your stock market portfolio from 4 to as high as 8% with a 95% success rate. And so what we're finding is that if by using cash value life insurance as a supplement or as a volatility buffer in retirement, then that allows you to draw an even higher sustainable rate of distribution from your stock market portfolio. Because remember, at the end of the day, it's not how much money you have, it's how much income you can draw off that money in retirement. That's the number that really matters in retirement. So if you can now, because you've got enough money squirreled away in your cash value life insurance that it can serve as an effective volatility buffer, you can now double your rate of withdrawal on your stock market portfolio. And that's massive. I mean, think about it. If you get $1 million in your Roth 401k and you don't have that volatility buffer, you're going to be constrained to taking, about $40,000 per year adjusted every year for inflation. If you can have a volatility buffer, that's going to allow you to draw as much as $80,000 out of that $1 million Roth 401k portfolio. That's massive. That's huge because we've used it as a volatility buffer. So these are just some of the different applications that you can use for these types of financial tools.
Yeah.